This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Commercial Investing Show, where we analyze, explain, and exploit the opportunities presented in today's commercial property marketplace. If you're interested in apartments, mobile home parks, self-storage facilities, and other income property, you've come to the right place. We'll explore what's hot and what's not in markets nationwide in the relentless pursuit of return on investment. Here's your host, Jason Hartman.
It is my pleasure to welcome a returning guest back to the show, and that is Lawrence Yun. You probably know his name. You've probably read a lot of his research. He is the chief economist for the National Association of Realtors and also the senior vice president of research at NAR. Lawrence, welcome. How are you?
Thank you for having me, Jason. So I think it's been many years since I was on your show, but the market has been exceptionally hot and constantly changing. So thanks for inviting me.
Yeah, it's our pleasure. And the question everybody is asking themselves nowadays is, how long can this continue? I think it has surprised everybody that this red hot market has gone on for so long. Of course, recently interest rates have risen quite substantially. Still, they're historically low, but they have risen a lot compared to their ridiculously low numbers. Where does that leave us, Lawrence? Are we in for a change or a correction, or just more of the same? I mean, inventory has actually declined since the rates go up. One might think on the surface it would go the other way. No?
The recent sharp rise in interest rates, which actually is surprising me. I knew that the interest rates, mortgage rate would be higher in 2022 versus what we experienced past couple of years. We know that inflation was picking up, and therefore the Fed would have to raise interest rate. It's surprising that Fed has only raised interest rate only one round so far, quarter point change. Yet the mortgage rate has jumped from 3% of last year, approaching close to 5%. So that's almost 200 basis point increase. And just to put it, what it means for first-time buyers, and let me put it in first-time buyers' perspective rather than a repeat buyer, because repeat buyer, they sell their home, they have the proceeds, and they can use that for the down payment, makes the transaction a little easier. But the first-time buyers, what they were considering last year, say same property that they are reconsidering this year, because of the multiple offer situation, and they were unable to win the bid. First, the prices are higher by 20% over a 12-month time span. So you say, 20% more prices. Then the increase in mortgage rate from 3% to say 4.7%, which is the Freddie Mac average. That is bumping up another 25% on top of the 20% increase in home prices. So one is looking at about 45% increase in cost burden to buy now versus 1 year ago. So inevitably, this means that some first-time buyers have already reached their financial limits and they simply cannot buy anymore unless they decide to change their perspective on the size of a home or different location. So it has become a huge burden.
I'm so glad you mentioned unless they change their perspective on the size of the home. And that's what always gives in these situations. It's standard of living. It's lifestyle. People just literally accept less. And Lawrence, I made the comparison recently in one of my presentations about someone moving from Jacksonville, Florida, and, what $1 million home is like in Jacksonville, Florida, which is basically a mansion, versus moving to New York City, and $1 million home, even if you could call it that, is 653 square feet, which is, they call it one bedroom. It's not even one bedroom. It's just one little tiny space. So the perspective has to change. But one other thing I want really for you to maybe unpack for the audience is this. You just talked about the comparison of a first-time buyer, or really any buyer. Now, granted, other buyers, if they're not first-time, they're trading equities. So they have the theory of what I call the theory of real estate relativity working for them, because they're not as impacted as the first time buyer is. And that's a fair statement. However, you compared it to a year ago, but a year ago, everything was essentially on sale, given that the prices hadn't risen much yet and the rates were so absurdly low. Maybe that's a false comparison. Is that fair to say? Maybe we should compare it to 3 years ago when rates were higher, or not. Just tell us about your thoughts on that.
Oh, well, Jason, you make a very good point. So I was thinking in terms of, say, people were involved in the buying process 1 year ago. They were frustrated because we have heard so much intense multiple offers. And the definition of multiple offer means one winner and multiple losers. So and they have to come back to the market, always looking for that fresh listings. So compared to 1 year ago, it has become cost burden. Now, compared to 3 years ago or 4 years ago, when mortgage rates were 5%, or I remember back in the year 2000, mortgage rates were 8%, and people thought that was pretty good rate back then at 8%. And my parents, when they purchased their first home in the early 80s, it was about 16% mortgage rates. So but people need to put it into perspective. As the mortgage rate is rising close to 5%, this is still historically very low rates. And compared to 3 years ago, the cost burden has increased because of the home prices, but not in terms of the mortgage rate changes. And especially, I think I like the example of Jacksonville, because as people have some degree of greater flexibility to work from home, especially those lucky office workers where they have been working from home the past 2 years during COVID. Now they're slowly returning to office, but I'm not sure what the right model is regarding the work from home. But the inventory, we need to get the inventory up, because when you see the sales decline, which we have been recording in our metric of existing home sales, coming down about 3 consecutive months, and people say, well, maybe the buyers are retreating. And that's not the case.
Right.
We still have multiple offers. The days on the market is still very swift. And let me give you this one chart on the inventory, I think, which will be quite striking. So let me put that onto the screen.
Sure. And so for people not watching on video, we'll try to explain the visuals that Lawrence is showing, but he is just a wealth of knowledge. NAR has so much research material. So this chart is an inventory chart. And of course, it shows a very low inventory number just past January of 2021. But what do you want to tell us about this?
So the inventory level is essentially at 1 million homes available for sale throughout the country. And just 3 years ago, it was about 2 million. And then one looks at back in 2008 period, at the start of the financial market crisis, foreclosure crisis, all that part, the inventory levels were 4 million. In this comparison, I think the important point is some people say, well, with home prices rising so fast, surely it is simply a repeat of 2008. Price goes up, then it's going to crash. Well, you look at this chart, and one major difference is the inventory level. Today, we have only 1 million homes for sale. Back in 2008, 4 million homes for sale. So in a tight supply market, one will not see a price decline. There's a housing shortage. Shortage means no price decline. I hope the prices do not rise so quickly to give first-time buyers some chance. But the point is, without the inventory, sales simply cannot grow.
Right.
So right now, we are experiencing some sales decline, but I would say that is principally due to the lack of inventory.
Right. So it's important for people to understand you can't sell what's not for sale. So people make this huge mistake. They say, well, look at sales, they're down. Well, that doesn't mean demand is down. People want to buy, they just can't buy things if they're not for sale. That's not a good metric to say number of sales. Sales volume is just a faulty, you could lead yourself to make a lot of poor decisions there. One thing I also want to say, because we quote the inventory numbers a lot from Altos Research, And the way they calculate inventory is quite a bit different than the way NAR does it. You may or may not be familiar with them. Of course, you've been around much, much longer. I can explain that on another episode maybe, or if you are familiar with them and want to address any of that, feel free.
So the way we have inventory count is all the inventory, whether it is for sale or under contingency, meaning that contract has been signed. So the other organization, may just say, well, we're going to remove the pending inventory because there's possibility that some pending may not go to closing, home inspection issues, appraisal issues. And just for the time series consistency, we've been measuring both the truly freely available along with the contingency. So at least time series trend would be very reflective of, say, other organization measurement like Altos.
Okay, that's good to know. So in other words, what you're saying, because I think this is just really important that we drill down on this for just a quick second. When NAR calculates housing inventory, they include what's for sale and what is a contingent sale. So if the realtor reports in the MLS that it's a contingent sale, that is still considered for sale inventory, right? Now,
yes, we counted that as an inventory. When we say inventory, includes even the contingent inventories.
Right. And now I know that NAR came out, and I'm really glad they did because I like this index, the pending home sales index several years ago. I remember when I was in traditional real estate years ago, you didn't have that. And I think that's a great other metric that you use. So your inventory, does it include the actual pending sales? Because just so everybody understands, when a realtor sells a property and the seller accepts the offer, they have the choice to report it to the MLS as a contingent sale, meaning that it's a less firm deal, right? Or a pending sale, which means that it's more firm, but it could still fall through even then. So are you including pendings or just contingents in your inventory?
The pendings are included. So again, it's for consistency, measurement for the history. So, whether one uses NAR data, Altos data, or how, maybe the local association has a different measurement. What one will find is today it's at historically low inventory. Well, say during the financial crisis, inventory levels would have been, say, 4, 5, 6 times higher than what it is today.
Right. Okay. So that's good to know. And what do you consider a normal or balanced market when it comes to inventory? Because when I look at the Altos data, and I've repeated this before, it seems like that inventory, and it kind of alludes to what you were just saying, needs to increase by 300% to 500% to sort of get to a balanced market. That's not considered a buyer's market or what some would call a bad market. That's just a sort of normal market. What do you think at NAR?
Well, in terms of how does one define what a balanced market is? So in the past, we just defined balanced market as when home prices rise in relations to people's income, consumer price index. So say the consumer prices rise by 4%, home prices rise by 4%, and there is no rush of people, multiple bid or decision where people may come measure decision about, well, do we choose house A or house B? And that was associated with generally about 5 or 6 months supply in our inventory measurement and the sales activity. But today, the month supply is at 2 months supply. So very, very tight. And that's the reason why we have the double-digit price appreciation.
Okay, so by NAR's standard, just so people catch what you just said, you have now about 2 months of inventory, meaning if sales continue at the same pace, it will take 2 months to absorb the existing housing inventory. And a more normal market would be about 6 months of inventory. So you'd have to have really triple the amount of inventory. Is that a fair statement?
Yeah, I think that's a fair statement. There's one caveat. I would say that given that today there's more home buying process done initially through the internet search, which the consumers are doing, heavy work. So maybe the month supply as we go into the future, maybe the 4 month supply is associated with prices rising similarly with the consumer price index in the future.
Okay, great. So feel free to show us some more charts. I know you've got some sort of favorites that you want to share with us today. So please share your screen and let's look at that. But while you're doing that, I just want to ask you, about the interest rates again. I mean, is the market going to cool off with the higher rates? It seems to be doing the exact opposite, but again, it might be too early to tell. And just for the record, I wish the market would cool off a bit. Now, not too much, but it could cool off quite a bit, and I would be happy, because I find this market a very difficult market in which to operate, with everything being so red hot.
But yeah, I mean, I think the realtors would like to see a calmer market
Yes.
because the multiple offer again means only one winner and multiple losers.
Yeah.
The losing group has to redo the contracts. They have to do the research, and just the frustration of not being selected. And people want that more normal market condition. Ideally, we want increased supply, more home building, and then we have more choices for consumers. And then this is how we get the transactions. But what's happening now is that we may get towards the balanced market in a non-ideal way, which is choking off demand. And here's a graph on the mortgage rate sudden change. Everyone knows the blue line that you see on the graph. Sharp upturn is the mortgage rate. But note how the red line, which is what the Federal Reserve directly controls. Federal Reserve does not directly control mortgage rate. It's a combination of multiple bond market, the global financial market. But Fed has raised the interest rate only one time, yet you see how fast the mortgage rate is rising. But furthermore, if one looks at the past history, one sees that at times when Fed aggressively raised interest rates, the mortgage rate barely budged. So it is possible, in my view, that most of the mortgage rate increases, may have already occurred. So any further jacking up of the interest rate by the Fed may not have any meaningful impact on the mortgage rate. So in other words, mortgage rate today, say 4.7%, by year end, it could be about the same, even as the Fed continue to raise interest rates.
I was just going to ask you that question. In other words, have the mortgage lenders sort of priced in anticipation of the future rate hikes that the Fed has already announced? And by the way, this Federal Reserve with Chairman Powell you don't really have to decode what he's saying too much. Like, I remember back to Alan Greenspan, you never knew what he meant. It was always a big job to try and figure out what he was going to do. But, they've made no bounds about it. They're raising rates. And have the lenders already sort of priced that in? Is that what you're saying?
I think it's not necessarily the lenders. Lenders it's a competitive market in the lending industry, and they see what the costs of, getting the fund, what they can charge. Is really about the 10-year Treasury bond yields. And the 10-year Treasury bond yields has moved similarly with mortgage rates. And that's why the lenders are, in a sense, forced to raise interest rate, because this is how the market has been turning. But essentially, you are right, Jason. It's already priced in for about 7 or 8 rate hikes by the Fed this year. The wild card is really about inflation. If inflation continues to rise faster, the sad situation related to the war in Ukraine is not helping on the inflation because food prices may continue to increase. Ukraine has been one of the big exporters of grain, and the harvesting time may not occur this year, along with the fact that Russia, they cannot sell grains overseas because of the sanctions. And of course, the lack of energy coming from Russia will also hamper the gasoline prices, to be elevated. And I think I have one graph on the inflation. Hold 1 second. Let me try to turn that.
And I'd love to see that mortgage payment chart you just passed as well. I think that might be interesting. Not this one, but you can talk about this one if you want. It looks like you had a payment comparison of how much the payment differs. Yes, I'd love to. Yeah. This is good. So what we're seeing here, everybody, is we're seeing monthly mortgage payment on an $800,000 loan. Now, $800,000 ain't what it used to be, right? So this is someone who buys $1 million house, and just let's keep that in perspective. $1 million house you can now buy with an FHA loan in some areas, right? That's like a program really meant for first-time buyers, largely. But at a 3% interest rate, that principal and interest, or P&I mortgage payment, is about $3,400 a month. and I'll just jump to 5%, that same loan amount is almost $1,000 more per month. It's $4,300 a month basically. So comments on this?
This is just based on the same loan amount. Right. For a person who was going to buy that home last year, the loan amount would have been not that you would have been cheaper because home prices were cheaper. Right. So this is a high degree of cost burden for the buyers. I put the 6% scenario. I don't think we will get up to mortgage rate being up to 6%, but just out of curiosity, the payment goes up to $4,800. Right. Last year, $3,400. So, these are substantial changes that is occurring from the rising mortgage rates. Market is still hot, but inevitably, just this number calculation is implying that the buyer pool will steadily shrink later in the year. And consequently, I expect overall home sales to decline about 6% this year. Home prices will still rise. And by year end, I think it will be a single digit percentage gain, maybe only about 5% price gain in December versus 12 months ago. But clearly, this cost burden, especially for the first time buyers, means that buyer pool will shrink. At the same time, the builders are building more, which means we will have more increased supply.
Yeah. And by the way, NAR really made quite a splash when they talked about how we're, 5.5 million homes short in the supply we need. Can you update your thoughts on that? And, how long is it going to take for that to rectify itself to where we get, or will we ever get to an even level where you don't even say we're 2 million homes short of what we need? Talk to us about that for a minute, because there's been a lot written about that. I'm sure you've spoken a lot about it.
Let me actually try to find that slide. So let me just bear with me as I scroll down some of the slides here.
No problem. This is hitting us subconsciously as you scroll through your slides. So it's great. Happy to see it.
Okay, so here's the chart on housing starts. And for only the listeners who don't have the visuals, what it shows is that it shows from year 2000. And I would consider year 2000 as being normal. And why do I can say year 2000 as normal? Because one looks through the newspaper articles and there was no discussion about housing market bubble or about any impending housing market crash. Housing was a very boring news event back in year 2000. And you say, well, boring means normal. Then you see so you say 2000 as a reference point for being normal. Then what one sees is that from the financial crisis in 2008, it has been below year 2000 level by substantial amount. And even with the increases in housing start steadily from the low point in 2008, it has been consistently under year 2000. So one tried to tie up this number to say, how short are we? Because America is experiencing job growth, population growth throughout the years. And of course, people need housing. I'm looking only at the single family units, but one could also find something similar in multifamily units because the rents are rising at double-digit appreciation in many metro markets. We have a housing shortage, not only for buying a home, but even the rental units. So we need to keep building. So 2 years ago, when we did the study, it was close to about 6 million units where we were short. I think Freddie Mac did some different analysis, little different methodology, and I think they mentioned that we were short about 4.5 million. So, one can dispute on the actual numbers, but housing shortage is clearly with us, and it's going to take multiple years. I would say probably 3 or 4 more years, assuming the builders can ramp up the production before we truly get to the point where we say we have sufficient housing in America.
And here's the $1 trillion question on top of that. What housing are the builders building? Because we all know they're not building entry-level housing. I mean, there's a few examples, of course, but not many en masse. There's just no building to the first time buyer market, is there? I mean, it's a figure of speech. I get it. There's a little bit, but not much at all. So the builders have found that they just can't make a profit given the high cost of construction labor, construction materials. And of course, whenever you sell something more expensive, you're going to have a bigger profit margin than selling something less expensive. So obviously the builders put their efforts toward the places they're going to have the least risk and the biggest margin. So do you kind of segment this at all in terms of, entry-level housing? Because the shortage is more pronounced there, isn't it?
Oh, yeah, absolutely. The shortage is on the intro-level homes, and that's where the intense multiple offers are occurring. The builders are building where there's a profit margin, because they have an option of, especially the Wall Street, as they are thinking about where to allocate capital, they want to allocate capital where they believe there's a profit margin. So if they think that producing electric car will produce profit margin, well, that's where the money will go. So from the builder's perspective, the money is flowing in to build a larger size, expensive home. Whatever they are building, even with the supply chain disruptions, high lumber costs, the garage door not arriving on time, they just tack on additional costs and buyers are still buying. So from the time that home is constructed, right now it's only taking 2.5 months to find a buyer. Now, it is not for the first-time buyers, generally speaking, but it does loosen up the inventory in a sense that these new homes, newly constructed homes, are for trade-up buyers. As they trade up, they are releasing their old homes into the multiple listing service for potential first-time buyers. So it loosens up the market, but without the new home construction, it simply doesn't loosen up. So even though it's more expensive home, bigger size home, it still helps the first-time buyers indirectly through the chain reaction on the inventory.
I really fear, and I feel like I'm the only one talking about this. I just don't hear anybody talking about it. Are we going to have a housing shortage for many, many years to come? I know you talked about how the builders will eventually build enough homes, right? But the problem is we've got tens of millions of people who have either refinanced or purchased a home in the last couple of years with these historically incredibly low interest rates. And I've always looked at the mortgage, Lawrence, as a huge part of the real estate asset, if you will. And I just don't think they're going to want to let those mortgages go when they can't be replaced at the low rates they've locked them in at for 3 decades. Does that lead us to just a continued housing problem where people don't want to relinquish these great mortgages they have? It seems like it may sow the seeds for a future problem.
We may have more of a lock-in effect. That is to say, homeowner, they say, well, house is a little small. We want to have extra bedroom. Maybe we want to buy, before they suddenly realize buying means 5% mortgage rate, and they have to give up the 3% mortgage rate they already locked in, whether refinancing or not. And suddenly they say, well, it's not worth getting that extra home at higher mortgage rates. So people get locked in. But nonetheless, last time we saw mortgage rate move, say going from 4% to 6% move, how many people were locked in? And what we find is that there's so many life-changing events. People find new job in different cities.
Yep.
People have children and they say house is simply too small. We have to get to a larger size home. Or the school district, people say, we want to, elementary school was fine, but for the middle school, we want to change the location. Yeah. So all these life-changing events really facilitate sales. So the lock-in effect, at least temporarily, when we did some analysis, we are finding that could reduce home sales by, say, 12% from what would be normal economic factors. So there is clearly a lock-in effect, but it is more minor percentage, maybe about 12%. Reduction in home sales compared to what it would happen without the lock-in effect.
The only thing I would say to that is, of course, people's lives do change, and that's what has traditionally and historically precipitated selling the home and buying another home. However, with these super cheap mortgages and the pandemic, people are working remotely, so they don't necessarily have to move to a new city. They are schooling online and remotely, so they don't have to move to like school districts could become sort of obsolete, right, in the more modern Zoom era as jobs have changed so much. So that could all happen. And I think this is actually going to cause a bit of a boom in the home improvement industry because people will be more likely to add a room, right? Add a second story where we can put the beautiful master bedroom upstairs and, keep the downstairs house just as it was, or, add on or improve the house rather than selling it because we've got this great mortgage. Or they decide to keep that house as a rental property, whereas normally they might have just sold it, right? And now this requires the financial wherewithal to do it, but I think a lot of people are going to have that given, we're going to see with 12% fewer houses going on the market in the future by your calculations, and I think it might be even less than that or more than that not going on the market, however you want to say it. That's going to cause upward pressure on prices, isn't it?
So anytime there's a housing shortage, it would always means that it will be a little more percentage growth in home prices. But there are so many factors influencing, the home builders aspect. We also have to consider this, terrible tragedy that COVID has inflicted globally. According to medical experts, they're looking at maybe 6 million people passed away from COVID in America alone, possibly reaching up to 1 million people passing away from COVID. Now, people can dispute, was it really a COVID death or heart attack death and so forth?
Or a motorcycle accident.
Or motorcycle. But if one looks at the death certificate, everything, drug overdose, heart attack, everything, it has sharply increased in the past 2 years. So without a doubt, people would say, what has happened in the past 2 years? So, COVID. And the people who have succumbed to it are people in their elderly age group, 70s, 80s. So there may be some people who need housing adjustment. Say a widow may want to downsize, or maybe it's an empty home that need to go through a estate sale. So we will begin to see some inventory also showing up from this terrible tragedy that has occurred from this ugly COVID situation.
How long does it take that inventory to show up, though?
So, it's for estate sale through the lawyer process. It may take a little longer related to the people who want to downsize. So we'll see how that goes, but. The principal source of inventory increase, it will be the builders. But I think people also need to be mindful that, America experienced, based on medical experts, roughly 1 million Americans passed away from COVID. And see, even if one was to shave that number to half, the disputing what's the true cause, that is an increase that requires some housing adjustment. And we have to wait and see. Housing unit does not mean one person because it's a household, which could be 3 people apart.
Right. So if it's an elderly couple living in a house and one person passed away, then you still need a house for the one that's remaining. Or if they were in an assisted living or nursing home facility, that doesn't really create a new housing unit as inventory. That's right. So it's complicated like everything, right?
That's right.
Okay, good. Show us some more of your charts and data, if you would.
Okay, so let me also share one local variation. So this chart is the U.S. map with 50 states, and it shows the current status of their job market, and the comparison is with March 2020. When America went through a lockdown or right before the lockdown. So some states today actually have more jobs compared to pre-COVID days. One sees it in the Rocky Mountain states and essentially what I call the SEC College Football Conference from Texas, Florida, out to the Carolinas, Tennessee area. And the other state is showing minus, meaning that they are still short of job compared to pre-COVID days. So if one is wondering which real estate market is the hottest, and it just directly follows the job market. I mean, sort of common sense, more jobs, people have income to buy a home. So the Rocky Mountain states have seen a substantial price growth. I think the latest Case-Shiller price index in Phoenix is showing about 30% price increase from 1 year before.
Yep.
Florida market, substantial rise in home prices, but also rents. rents in Tampa, Jacksonville, rising 15% from 1 year before. So
I'll
the
tell
real
you,
estate.
My ex-girlfriend is looking to move to South Florida, and she told me that she was just, she's got money, she's successful, and she told me that she was looking at apartments. She just wants to rent first, right? And there is literally nothing available at any price. It has been such hard work, go one apartment complex to another, looking at individual landlords renting condos and things, just an ultra tight rental market, regardless of how much you spend. She just keeps upping her price. Like, I'll spend $1,000 a month more. Doesn't seem to matter. Just incredible.
And the interesting phenomena recently is the multiple offers on rentals. So I'm not talking about the investors wanted to buy, but it's more like people who want to rent a property. Yeah. And they said, well, work from home. Maybe I want to rent a townhouse rather than an apartment complex. So they go and look for the rental unit, and there are other 10 renters showing up to say, oh, we want that rental units. So now there's a multiple bid among the renters for units. And which is the reason why
multiple offers on homes for sale and homes for rent.
Yeah.
Multiple offers either way, just shortage. Yeah.
And one thing also that's exacerbating the inventory shortage is that given the strong rent growth, now we have the Wall Street coming in and trying to pick up single family rentals. And that is also taking away the inventory.
Yeah. So about 33% of all homes purchased nowadays are purchased by investors. And we've got these big Wall Street style investors. Do you see them continuing to buy more properties over the coming years? Or is that maybe a phase, and they'll sort of buy and then they'll just hold what they have? They've got, in the aggregate, hundreds of thousands, if not, I don't know, maybe even millions of homes now. I'm not sure of the latest numbers, but do you see them continuing to just keep buying, or how do you see that?
Well, the Wall Street companies will back off once they see the rents beginning to decelerate. But right now it's an accelerating rent trend. So how do we make the rents decelerate? Produce more homes, construct more homes, construct more apartment. But as long as there is excess regulation in home building activity, apartment building, it just means the Wall Street will just be in the market and essentially pushing out the first-time buyers with their cash deals.
And I don't even know if NAR does any projections or much research on the rental side, but do you have any data on rent projections? How much you think rent will go up this year? I mean, it's gone up extremely high, but how much more are we in for this year, next year, et cetera?
So the rent data is a little trickier. Census tried to keep data on the rents. There's a consumer price index component where they try to compute what the rents are, which is rising about 8% above 1 year ago on an annualized basis. And the data from like CoStar, which measures all their apartment and part, they are seeing rent growth in the double-digit percentage rate. So there is a divergent rent data, but one consistency is all are accelerating. And my guess, from ordinary person, ordinary renter, so whatever rent they are paying now, they should expect next year probably about 6 or 7% growth in rents.
Right. Wow. That's incredible. Okay. Keep going.
So let me do one more chart because, I think I'm reaching the time limit. So let me see what the interesting part would be. Maybe I'll just start with the NAR membership, which is quite interesting.
That's an economic indicator, by the way.
There is a labor shortage across America. Help want to sign at a restaurant, help want to sign in the construction site, everywhere, because there's not enough workers. But one area where there appears to be possibly a surplus of workers is people want to become realtors. The housing market has been good. But every time there's more realtors coming in, it just makes the business environment much, much more competitive. Say a newly minted realtor, their first client is their uncle, which means that their uncle is no longer available to other realtors who have been in the business for many years. So it's very, very competitive. But I only want to illustrate this to say that from consumers' perspective, you have many, many choices in terms of which professional you want to work with. From the realtor's perspective, I want the professional to recognize that it is a competitive industry out there. They already know it, but it could be even more competitive with so many people entering the business.
Yeah. So NAR membership is interesting because it is, I believe, the largest trade lobbying organization in the world. And you've got almost 1.6 million realtor members now. But comparing that to, 2012 or so, you had about 1 million. So your membership is up 60% since then. That's a huge jump. What does NAR membership tell us? Is this a proxy for the real estate market or the economy? Do you tie it in that way? I kind of do. I think it's a bullish sign. When everybody's becoming a realtor, that's a sign of faith that the market is going to continue to grow. What do you think?
So that's the expectation of the new members who are coming in, that market will continue to grow. But the reality measurement is that the membership is actually a lagging indicator of a housing market condition. So the fact that we had an exceptional housing market the past 2 years, this is drawing new members. We have higher interest rate. I do expect home sales to come down, not prices, but home sales to come down this year. It means that the membership number may turn negative 2 years from now. It's more of a lagging indicator rather than a leading indicator, because it's not about the realtor's optimism that drives the market. It's really about the consumers. Do they buy more homes or do they not buy homes? And with interest rate rising, we will see some cooling in the market.
Mm-hmm. Yeah. Well, let's hope so. Let's hope the home builders catch up a bit so we have more inventory. I think that's what everybody wants. And the thing the government needs to do is they need to back off on building restrictions. They need to make it easier for developers to do their thing. And, I would say instead of incentivizing first-time buyers, how about incentivize developers to build things? That's what needs to be done. What else do you want to just wrap it up with, if you would, knowing that our audience is mostly investors and they're looking to buy rental properties and build a portfolio of investments that they can ultimately retire on or have financial freedom with?
Well, you made a good point. I completely agree that we need more supply, because during this housing market boom, what we have seen is that home ownership rate did not increase. But we had increased home sales, increased prices, because the real estate investors were in the game. And the real estate investors, they are constantly on the lookout for opportunity. And they saw an opportunity from the housing shortage. Housing shortage will not dissipate overnight. It's going to take multiple years. So in terms of the home price growth prospect, it will continue. Maybe not as intensely strong appreciation as before, but the rents will also rise. And just one final comment is, when one looks at, say, the REIT sector, which is essentially buying commercial buildings and they're collecting rents, they look for some price appreciation. And what happens during the high inflationary period like we are entering is that most of the financial return is associated with rent increases and not necessarily price increases. So rents are accelerating, and it's currently in an accelerating trend.
Right. So you don't have to see price increases if you have rent increases. I talk about that in a technique I have called the 3 dimensions of real estate. So that's absolutely true. Lawrence Yun, Chief Economist for the National Association of Realtors, thank you for joining us today. We appreciate all the charts and research that you've shared. Thank you.
Thank you.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.